Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. Conventionally, the Reserve Bank of India has been very conservative when it comes to regulatory controls. It is often erred on the side of caution. In fact, some believe that it has stifled innovation and agility of banks. Not any longer. The just presented Reserve Bank of India credit policy has flipped a switch, as it were. Almost overnight, the Reserve Bank of India is initiating freedom for banks, more play for markets, and a very specific focus on the ease of doing business. The obvious questions are, what will it do to India's ecosystem for credit? More importantly, will this freedom bring with it increased risks to the banks and thereby the financial system? To answer all these questions and more, we have with us today Ashima Goyal. She's a professor at IGIDR and a former member of the Monetary Policy Committee, and of course, a previous guest on the show. Welcome, Ashima.
Thank you. Nice to be here again.
So, Ashima, I wanted to begin before we did a deep dive into the various proposals the Reserve Bank of India has put down in the credit policy. I was very curious to know as to what prompted this rather very sharp pivot that the central bank undertook, meaning, and why now?
I think the government has been focusing on regulatory simplification as part of increasing the ease of doing business. So, if you will notice, all financial regulators have been moving towards simplifying and fine tuning regulations. Even SEBI has done quite a bit, RBI, and so on. So, I think it's very much part of that. And if you look at what they were briefly, they put some draft circulars for comments, etc. They're proposing to do away with 9,000 circulars and replace it with 238 consolidated. So, I mean, imagine if you are a regulated entity, you have to comply with thousands of instructions. You won't know, there's no way of knowing what the aggregate impact is, which direction it is pushing that entity, apart from preventing them from doing all kinds of things. And it's not even clear how all that interacts. So this sort of regulation and simplification is very much needed. And actually, in the 90s, when the reforms started, the liberalizing reforms, it's a Narasimhan Committee on Financial Reforms. And the idea was to move away from controls towards more market, determined, freer markets. And again, because financial stability is very important, so it was going to be gradual. But then it was interrupted by all kinds of external shocks. Our own NPAs accumulated. So I think there was a movement towards very detailed rules. And now the financial system is strong and it's shown the ability to withstand many kinds of shocks. So it's the right time to move further on this path.
Fair enough. Also, I guess India's set down very audacious ambitions for itself to become a developed economy by 2047. So I presume this pivot is in line with those kind of ambitions, right?
Right. Yes. Yes, very much so. We need much more financing, investment, etc. So the financial sector has to deliver much more.
So Ashima, I'm curious. You have served on the MPC, so in a way, you have a inside window into the way the central bank functions. So in this kind of policy pivot, fair enough, it's happening across all regulators. But in this instance, how important is the leadership of RBI? Because from whatever I know, covering it for 2, 3 decades, it's a very conservative institution from top to bottom. So, is this possible that a change in leadership alone is also contributing to this pivot?
Yes, it is a very hierarchical organization. So it really does get driven by the focus of the governor. And but then it has a very deep domain expertise, layers and layers of it. I'm sure all of that also influences the governor. But I think in this particular case, the very first speech the governor gave, the first MPC resolution, he had said we have to look at the cost of regulation. No? So I think the speed with which change has happened, the focus on simplification, and the pushing the organization to deliver. I'm sure all that is coming from the change in leadership. And this governor has the advantage of being new and not having lived through crisis, because once you have been through those, then you tend to be very cautious and conservative and you're afraid of a repetition. So I think all these factors have apart from the government direction, all this, so the governor's own leadership has contributed, I'm sure.
So now, Ashima, if we can move into the proposals, one standout proposal is the decision of the central bank to move away from control to supervision when it comes to bank lending, which basically means the risk assessment is going to be done at the level of banks more than the Reserve Bank of India setting guardrails. So, what are your thoughts on this?
I, I refer briefly to the Narasimhan Committee and the idea of reforms. It was to move away from controls. In the 90s, we had the Harshad Mehta scam and et cetera, et cetera. There was a realization that a control structure is also very fragile, right? So, so and even though there was a revival of various types of controls or detailed rules, at the same time, there was reform going on gradually, market deepening, development. And over the last few years, when I was in the MPC, I saw that and before that, I was in the board of a public sector bank. I saw the kind of changes, the board independence, board driven policies, very little, government intervention had almost disappeared. So there was this sort of regulatory strengthening of corporate governance through the financial sector. And I would say that the focus is on supervision, yes, and supervision is required in the financial sector with very many temptations. But this risk-based lending, policy-driven boards, transparency, all that means that it's not just supervision. It's also aligning the incentives of financial sector participants uh, in a better direction. Because I think I've done some study on the kind of regulations in advanced economy financial sectors compared to emerging markets. And emerging markets use a lot more of prudential regulation. But after the global financial crisis, there was more of a focus on this. And Dr. Reddy was the first to use counter-cyclical, rise in risk weights on housing when credit was booming in the 2000s, etc. So, so this kind of regulation is creates good incentives, because financial sector tends to have booms and busts, and once you have this, then you don't need too much of the very detailed rules, etc. That is what I like to say. It's like emerging market, or at least Indian regulations, like the kitchen sink. You throw everything at it. You already have one set of rules that are working in the right direction, and you and then you put more and more and more, which is overdoing it, right? So in emerging markets, in advanced economies, on the other hand, they, after the global financial crisis, they were really focusing on banks, because it originated in banks, the securitization, etc. So they neglected the rest of the financial sector. And most of the regulation was on the credit side, the borrowers, rather than the entities. But here we have much more on entities. We have broad, even for NBFCs, there's scale-based lending for different kinds of NBFCs. We don't have. So what happened in advanced economies was that there was arbitrage away from banks towards the rest of the financial sector. So today we are seeing a lot of the inflows that come into emerging markets come from non-banks. But we have this broad-based regulation. So it's not that it's only bank decisions, and even bank boards and supervision has strengthened. Yeah. So I think that we have space to relax on the kind of relaxations that are happening without it necessarily creating more risk. For example, I just looked at this draft circular they circulated for comments for NBFCs. Now, there's an item 17 which says that the leverage ratio of an NBFC shall not exceed 7 at any point in time. So you have leverage. One of the ways that booms occur is everybody's lending at the same time, and your credit can be much larger than your liability, too high a multiple of your liabilities. So you have rules that prevent this sort of thing. Yeah. And you need those kind of simple rules to prevent arbitrage, more applying on NBFCs as well as banks and other financial sector entities. So if we have
So
all
basically,
this,
a
I
very
think
soft
the
touch.
market is, yeah, and this is linked to, this is something that affects, like Dr. Reddy used to say, risk weights are very effective because they immediately affect your bottom line, right? If you're lending too much to an entity where the risk weight has gone up, you will reduce lending there. That's a way of reducing lending in areas where it's like credit card loans are going up 30% last year. So you have those kind of tools which create correct incentives. This is macroprudential and microprudential tools. And so we are using a lot of that. And therefore, while more of the risk, and one of the things that happened before the GFC in advanced economies was there were these own risk based models. Banks were keeping capital based on that, and they were underestimating risk. So it led to the crisis. The trouble with own models is you have the temptation to underestimate risk and keep too little capital. But then we have capital adequacy norms, and our the balance sheets of our financial sector is very strong, much higher than the regulatory norms also. Right? So we have all kinds of safeguards in the system, so the detailed rules can safely go ahead.
Fine. The also, I guess, like you mentioned, the external circumstances are much more sound for India today, relatively, than what it was, say, 20, 25 years ago. So, I wanted to do a quick follow up. So, in a sense, is this the benchmark moment where, the post crisis regulatory era is over and now we are talking of a different era from now onwards?
Well, I think you don't have that kind of sudden change because even in the 1990s, when we had the liberalization, it was gradual. Our reforms were gradual. For example, we didn't apply the Basel standards immediately because that involved too much of its own risk assessment, etc. And it felt that our banks are not ready. So there were external kind of requirements imposed, and slowly the even external inflows, the liberalization was gradual, sequenced as markets deepened. So I think we've had periods where reform progresses faster, periods when it's slower. There might be one step back, one step, two steps forward. So I think now we are in a in a space where since we had trouble in the 2010s and tremendous reforms, even the bankruptcy reforms, etc., all kinds of strengthening of financial sector balance sheets, corporate balance sheets. So now we have, and 2010s was a decade when there was huge leverage created throughout the world because of quantitative easing and so on. But we had the opposite conditions in India. We had monetary, fiscal, financial tightening, right? So we have the space now to relax without it creating financial stability problems. So this is a period where we can move maybe 4 steps forward safely. Let's put it like that.
Great.
Yeah.
Great. Just like 1991 was an acceleration of economic reforms, which was already happening in an iterative way earlier. I guess this is another moment. I wanted to, bring your attention to another part of the liberalization they announced, which was pretty significant. It was external commercial borrowings. They have virtually, freed them, and you can borrow from any entity abroad. Now, some call it the 1992 movement in reference to the point when foreign investors were allowed in equity in 1992. It's not that foreign investors are not allowed in debt today, but to this extent, the kind of freedom they have been accorded is quite unprecedented. So, your thoughts on this too?
Now, I think again, to go back to the earlier analogy, although 1990s was a drastic big break, a huge reform, but the financial sector reform was gradual. Even equity, it was not 100% equity allowed. There were limits and sectors where, etc. So it was gradual. The same way, and then it was interrupted by the East Asian crisis. And their short term debt really created a lot of risk and hurt those East Asian economies because this kind of debt, when there's a crisis, it just goes out, and that's the time your currency is depreciating, and it can really play havoc with your financial system. So we went slow on, and it was this part of the sequenced capital account convertibility. Equity is risk sharing. So if it goes out, it's taking out less resources. It's less of a strain on the economy. So, and then long-term debt was allowed. The controls were raised. Short-term debt, there continued to be restrictions. But now, I think the key issue is that you need to relax these restrictions, because these are detailed rules. After, say, this cab you can't bring in, which creates transactions for costs for investors, etc. But the idea is that it should not be too large as the size of the domestic market. So gradually, these debt caps have been lifted, and there was this certain categories of, say, government debt where it was allowed freely. I think that flexible FR it's called, yeah, um, uh, where there's no restriction on inflows coming in and going out. So already there was total freedom there. But on other kinds of debt, the restriction was about 6% of the domestic market. But even with this far, the freedoms given there, the total foreign debt did not go above 2%, of domestic market. And then last year we had Indian debt, government debt was included in various global indices, Morgan Stanley, etc., Bloomberg, and it was expected to lead to about $40 billion coming in. But what came in was only $20 billion. So it's not as if opening out or integrating more with the world will lead to a huge unmanageable inflow. In fact, the thinking is that even as you remove all restrictions on debt, foreign debt inflows into the country will stabilize at around maybe 10% of domestic market. Currently, they're only 3% or so. Yeah. And this much can be safely absorbed without creating excess volatility. During the taper crisis, when they started quantitative, Mr. Bernanke in the US, and there was flight of capital from emerging markets. Now, at that time, Indonesia, foreign debt constituted about 40% of their market. And there was huge volatility of the interest rate, because debt suddenly going out can, force you to raise your interest rate, which can hurt your domestic cycle, etc., etc. But in India, we had very low exposure. So our rates only went up because that time the RBI thought it necessary to raise them. It was not necessary, not because of debt outflows. So I think that this is part of the gradual liberalization. And removing restrictions on ECB means there are much less forms for firms to fill up. They can take decisions in line with their business requirements. Yeah. So in that sense, it reduces transaction costs. And like we see this in equity markets, because domestic SIPs are so much larger, domestic institutional inflows. Even though foreign portfolio equity flows have been going out, we've not seen that kind of volatility in equity markets we used to see earlier. So debt markets need to develop more. They already have deepened domestically. Now there are more pension funds and so on taking positions there. Yeah, so we can afford to have more foreign inflows. They will help develop the markets further. And actually, debt is really required because of our we want to expand infrastructure, and equity is a very expensive form of borrowing. Now, debt can be much cheaper, and you need a blend of the two. So I think we are moving in the right direction at the right pace at the right time overall.
So, Ashima, I was curious to know your thoughts on how all this deregulation will play out for competition and innovation in finance, especially in the era of AI. We are already seeing the applications in fintech. So, how do you look at the overall financial system innovation within that?
Yeah, again, just to compare, because I think what happens is when you have a lot of regulatory changes, people don't have that long memory, right? And they're reacting too much to the present moment. Well, it's very good to have a historical perspective so you don't repeat the mistakes you made in the past. So I think before the global financial crisis, there was a belief that regulators are dodos. They don't know what they're doing. Markets are really smart and they know how to factor in risk, and innovation is really contributing to growth, etc. They should be freed, right? And then we saw the way markets blew up, the most advanced markets. So after that, there is more of a realization of the kind of problems markets can get into. This sort of excess volatility, taking too much risk, loan pushing, etc., etc., lack of transparency. Yeah. So I think now we are in an era where there's a better balance between markets and regulators. Yeah. So as I said, prudential regulation, which affects the incentives of markets. For example, you increase weights when there's too much credit going in a certain sector. Yeah. That will reduce the credit going in that direction. And it improves the incentives of market participants. And then better corporate governance, disclosure, board uh, super and regulatory supervision. All that improves the transparency. So you need this combination, and then innovation is like I think our regulate we have these regulatory sandboxes, yeah, and where you can try small pilots before letting them loose on the whole system. And the idea is they should be thoroughly understood and should be transparent, because very often you have complicated structures which can blow up in strange ways if they're not fully understood. So I think the combination, as I say, things evolve; they don't stay the same. We talked about history, but also evolution and innovation. But I think it is a better kind of process for innovation now, which is more consistent with financial stability.
So, finally, Ashima, I want to return to the beginning where you alluded to the ease of doing business. Now, this is the third rail of India's governance structure, which has acted like a dampener and probably costing us a lot of growth. So, if 1991 was the end of the license Raj, can we look at 2025 as the beginning of the end of the Babu Raj, pulling all these elements, whether the union government, regulators, anybody in government moving to improve ease of doing business?
Yes, that is why in answer to your question, I said that the governor has a large role, because the government has been talking about ease of doing business for a very long time. But you talk to the businessman on the ground, he says things haven't really changed. And they're still uh, complying with hundreds of rules, and all you can do is tick boxes. There's not much more. So it really depends on how much that individual at the top is going to push it. Yeah, the commitment to it, and of course the government is also pushing it. But I agree that I think the external pressures are there now. The Trump tariffs are very and the all the global volatility is going to push. There were some people in Delhi, they say it's amazing the things that are happening in Delhi, the way people are moving, the number of things being done finally. Actually, those ideas are there, but to act on them. So I think we are seeing that momentum build up. So combination of the right person at the top, the push from outside as well as from the government should see real change happen. But the big issue is really that however much the center does, however much a financial regulator does, unless state governments also participate, because for that individual business, very often it's state rules, or even then municipalities, large cities, they also have all kinds of obstructive powers. So you need this deregulation to reach all levels of government. And in a federal country like ours, I think that has to be the new focus and push for it to really result in substantial ease of doing business.
Okay. Thank you. It's a perfect note of riding between optimism and caution to sign off on.
Thank you.
You all heard Ashima. She unpacked the Reserve Bank of India's what we believed was a fundamental pivot as an argument that reforms in India have been happening iteratively, sometime with greater momentum than other moments. And this, in this instance, is a moment of acceleration for reforms on the financial sector. But it is not happening in isolation. As Ashima pointed out, this is being witnessed across other regulators, including the Government of India and some state governments too. So finally, India seems to be getting its act together under pressure, maybe due to external sources, but maybe to the with the intent of realizing its audacious ambition of becoming a developed economy by 2047. Whichever way we look at it, this marks a new beginning. Thank you for watching. Don't forget to subscribe to StratNewsGlobal.Tech on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas, and suggestions with us. I'm available on X at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.